Welcome to Weekend Wisdom. Today, we're going to talk about stretch IRAs. What are they and how do you and your family take advantage of it? So grab your cup of coffee, sit back, and let's get started. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget you can click Show More for additional information, links to articles on today's topic. Also, if you're looking for a different opinion, that of Big TV or Wall Street, please do consider subscribing to our channel. So today we're going to talk about stretch IRAs. Now that is the marketing term. It's actually what's called a decedent IRA. So a couple things we need to know before we get started. One is when we take distributions. So 59 and a half, that's at that point where you can take distributions without penalty. At 70 and a half, you have to start what is called required minimum distribution. So that is important to know. Next up, how about beneficiaries? When you're setting up your IRA, we make sure we go over this every year, but who can be a beneficiary when it comes to a stretch IRA or even a regular IRA? Your spouse, children, grandchildren, friend, charity, estate, or trust. Nope, sorry. Leona Helmsley, yes, she left her estate to her dog, but that dog cannot stretch. Next up, stretch IRA basics. Really, it's a strategy to continue, extend the life of your IRA. So after you pass, that IRA can continue on for many, many years. Very simple. So what's the advantage here? Maximize potential tax-deferred growth, create a lasting legacy to your heirs. Now, the first thing is uniform lifetime table. You can get this. We have a link below at irs.gov. This is your standard table. So at age 70 and a half, when you must start taking distribution, you're going to have to take your year-end balance, divide it by your year. The factor at age 70, that's 27.4. But when it comes to stretch IRAs, there's another table, which we have a link to. And the advantage here is, as you see, it starts at 0, kind of odd, but 1. So a one-year-old grandchild, their factor, and again, it will continue on to age 100 plus. So if you have your spouse, still use the regular table, but when you do the beneficiary, when we stretch it, we use the other table. So a quick example. Let's say the parent is age 75. They have a $250,000 balance. Year end, their factor that year is 22.9. So you take the 250 divided by 22.9. They're going to have to take out $10,917. The IRS wants their money at some point. So in a decedent IRA, when your child takes this over, let's say they're age 50, same thing, 250 balance, except their factor now, life expectancy 34.2, they're only taking out $7,309. So roughly a 30% difference, pretty significant, so it allows them to grow more money. Let's show another example here. Here's Betty, age 60, $200,000. She names her sons, Max, age 34, Sam, 40, as beneficiaries. So in 10 years, she starts taking her distribution. At that time, $16,480. Now, unfortunately, Betty dies early, okay, after receiving 3 years of RMD payments, $53,443. So now we split that IRA between the two sons. Why do we do that? Because they're different ages, and then each of them can take their distribution based on the age. If you kept it together, the oldest is going to take that. Now here, Sam, not the smartest, Sam decides to liquidate his portion. Immediately, Sam's lump sum distribution is going to be $243 158 minus taxes, going to be a big hit there. Federal, state, you name it, big hit, okay? Sam, what were you thinking? Get advice next time. Now, Sam receives that same amount, but he actually is going to stretch his IRAs and take his distributions. He is age 47 when he inherits it. And as you look at the example here, okay, he is taking out $1.43 million. So $1,436,936 in distributions. Wow, what a great number. So a couple things to consider here. Titling of your stretch IRA. The IRA is still owned by the deceased. That's why it's called a decedent IRA. So it's going to be titled John Smith Deceased, FBO, for the benefit of John Smith Jr. And you're going to have both ages in there when we figure out those calculations. Taxable. Yes, those distributions will be taxable at your tax rate. If you're pre-59 and a half, it is not taxable because, again, it's not your IRA. You're taking those distributions, so you're able to take it, but it's just taxed at the regular tax rate. You can take more than the required minimum distribution. How about a trust? Well, got to be careful here. You can name a trust as a beneficiary. I recommend you go to a lawyer, but you have to have a couple things. One, you have to have what's called a look-through provision on that trust. The reason being is the trust is not a living thing. So there's no age factor. So if you don't have that look through, you're going to have 5 years to distribute it, but look through, name the other kids. Disclaiming assets. Let's say if you have 2 children, one disclaims, and you would think it would go down to their kids. No. If you disclaim, it goes to the other child. So you have to be very careful with that as well. Grandchildren. Yes, you can do that. We saw that table. You could have a grandchild get 10%, 15%, whatever the number is, and they're going to take money based on their distribution table. So really a great advantage here, but you got to be careful, okay? Because why? Because you can't trust the kids, right? Got to be careful with those grandkids. You don't want them going out and buying a Camaro. Now, the other thing is minors are not allowed to have those IRAs, so you have to make sure. Check with your custodians, see if they'll allow it. Maybe somebody else can oversee it for them, or again, go back to the trust, and the trust can distribute this. How about your 401k? Chances are no. You got to check with the custodian. And I say no, my experience has been no over some time. And the reason being is the 401k provider does not want to be in the, what I'll call, the business of offering advice. So you really have to be careful there. So you want to move it out of your 401k, 403b, if you want to take advantage of the stretch IRA. So wrapping things up, stretch IRA, great concept, great idea. The last administration tried to get rid of it. That has not happened. It has continued. This is just a tax code. Everybody can take advantage of it. Make sure you get advice, talk to an advisor, a tax professional, a lawyer, but everybody should be aware of this. Make your kids aware of it, and as part of the planning process, take advantage of it. Thanks so much for watching. Michael Loftus for Wealth and Wisdom TV.